Good afternoon. This is Jim Bell, President and Founder of Bell Investment Advisors. I'm here with Anthony Liang, Tax Manager at Shoe & Waters in San Francisco. Anthony's been a long-time resource for me personally and for our firm and many of our clients. So, Anthony, we're very happy to have you with us today. This is our webinar on small business tax planning that Anthony has designed for us and for you. I just want to let you know if you're having any audio or visual difficulties, technical difficulties, please submit that problem to us as a question in your question box. We'll get back to you right away. Or you can call our office at 800-700-0089, 800-700-0089. Anthony Liang has long Northern California roots. He did his undergraduate work at UC Davis. He has both a Bachelor of Science in Managerial Economics and a Bachelor of Arts in Political Science. His law degree is from Hastings College of Law in San Francisco. He is a Juris Doctor with concentration in tax. And as I mentioned before, he's the tax manager at Shoe & Waters and a member of the State Bar of California. So on the first slide here, just as this is an overview of what Anthony will be covering today. And so we have a lot of information, good information to cover, so I want to just go ahead and turn it over to Anthony. And again, Anthony, thank you for joining us today.
Well, thank you for having me. So we do have a lot of information to cover, so I'm going to try to speed through this. For small business planning, there's really just the categories we have: entity selection, accounting method, loss limitation avoidance, some tax incentives you might have missed, and some opportunities with defined benefit plans. Now, with entity selection, there's really four types of entities that the IRS recognizes. There's sole proprietorships, there's partnerships, there's corporations, C corporations for that matter, and S corporations. So choosing the right entity for your business is the start of tax planning because it not only impacts what you can do for your income tax planning, but it also has legal liability implications, legal implications, and also California franchise tax implications. So starting off with sole proprietorships, that is the default entity type. If you do not have an entity, you are treated as a sole proprietorship. There's no franchise taxes with sole proprietorship, so that's kind of an advantage. But there's also unlimited liability, meaning if you do something wrong, someone's going to go after you personally. So that really having an entity, a limited liability entity like an LLC, a corporation, or an S corporation, really helps shield you or your other assets from whatever this business is doing. And it's a cheap. The franchise taxes are effectively a cheap, unlimited liability insurance policy. Another thing with sole proprietorships is they're going to be subject to self-employment taxes. Self-employment taxes are just basically the Social Security tax is 12% and Medicare tax is 2.95%. Any income that you generate from the sole proprietorship is going to be subject to that. That's not the case with S corporations. It's not necessarily the case with partnerships, as we'll go over. The key reason why in our practice we don't like sole proprietorships is what's on your screen there. There's a lot higher risk of IRS audit with sole proprietorships. If you take a look at the slide here, you're going to see that these are from the 2010 audit statistics from the IRS. Take a look at the highlighted section. It says business returns without earned income tax credit, non-farm business returns by size of total gross receipts. If you go to the 100,000 to 200,000 range and over 200,000 gross receipt range, now this is not income, net income. This is gross receipts. Look at the percentage covered in column 3. 4.7% for businesses with 100 to 200, 3.3% for businesses with 200,000. And you might think to yourself, that's not that bad. That's those are good chances. Go down below and see partnership returns and S corporation returns. Same column 3, 0.4% coverage for both. It's an order of 10 times magnitude difference in how often partnerships and S corporations are audited versus versus Schedule Cs. And on top of that, people auditing Schedule Cs, to be quite frank, I've gone through a lot of tax examinations. They are not as qualified as the people that will be auditing a partnership or S corporation return, which means you will have a harder time dealing with them. It will be a hassle, and by default, if they don't understand it, they're going to deny your position, and you're going to have to go to appeals. That's how things end up being with sole proprietorships. Moving on to partnership type entities like limited liability companies and general partnerships, I do want to point out that if you have a single member LLC that is not elected to be a corporation, you will be treated as a sole proprietorship, so it doesn't do you any good for tax purposes to be a single member LLC, except you will have unlimited liability, as I mentioned before, if you have an entity. Multi-member LLCs are treated like partnerships. As I mentioned before, there's 4 kinds of entities. LLC is not a kind of entity. LLCs can elect to be pretty much any one of the 4 kinds of entities, so it's about how you use the LLC. The LLCs in California have a gross receipts-based franchise tax. So if you have a low-income, high gross receipts type business, you may not want to use an LLC. It depends. Your alternatives are an S corporation or a limited partnership, as I'll discuss further. Note I don't say C corporation because we don't like using C corporations either for small businesses. Self-employment taxes for partnerships, they effectively are subject to self-employment taxes just like sole proprietorships unless they are equivalent to a limited partnership interest. A limited partner in a partnership is not subject to self-employment taxes. There have been regulations that were issued by the IRS kind of denoting when an LLC member could be treated like a limited partnership, and those regulations were withdrawn. It's an unclear area, but it's possible to do, or rather people are doing it, and there's no clarity on when an LLC is treated as an LLC member is treated as a limited partner or not. With all partnership type entities, there's flexibility in inserting and removing assets. You can take an asset, put it in an LLC, and not face taxation. You can pull the same asset out and not face taxation. That's different from a corporation. With a corporation, if you control the corporation, you can put an asset in tax-free. That's no problem. But you can't pull it out. If you try to pull the asset out, you're going to trigger gain or loss on the asset. So that is an advantage for partnership type entities like LLCs and limited partnerships and general partnerships for dealing with asset-based type businesses like real estate rental businesses or equipment rental leasing businesses, stuff like that. Things where the asset generates the revenue. If that's the case, you do want to go with a partnership type entity so that you can move the assets around if you need to. Another advantage of partnership type entities is if you have outside transfers, if somebody, including transfers upon death, there's an inside basis step up which gives you an immediate tax benefit of additional depreciation versus a corporation that doesn't have that inside basis step up. I can't go into what inside basis step up means, but it basically means it's a good thing. All right. Moving on to limited partnerships. Limited partnerships are good for real estate, large commercial real estate, or just large real estate entities where you're generating enough gross revenue that you are not that you're paying the higher tiers of the LLC gross receipts tax. The franchise tax in California for a limited partnership is a flat $800. So no matter how much gross revenue you have, you're just paying that $800. I failed to mention this before, but with partnerships and S corporations, they don't pay their own income taxes, so there's no double taxation. You pick up the income taxes on your own individual return as a flow-through. So same thing, that's the case here. The one deal with limited partnerships is limited partners can't participate in the business. There has to be a general partner that runs it. The general partner is subject to unlimited liability. The way around this is you make the limited partner a small 1% interest owner, and that general partner is an unlimited liability company or a limited liability company or a corporation. And you basically have full protection for yourself that way. As with partnerships, you have the same tax provisions where you can put property in and pull it out. And you have the same basis step up on transfers. Moving on to S corporations. Now, S corporations have the advantage that, well, they have a different franchise tax regime. The California franchise tax is based on 1.5% of your net income instead of gross receipts. So if you have a high gross receipts, low net income business, and it's not asset generated, it's not rental, you want to consider an S corporation. You also want to consider an S corporation if you have an operating business. That's because the income coming from the S corporation is not subject to self-employment taxes. Moving forward in 2013, there will be the new 1.8% Medicare supplement on passive income, which may or may not apply to your particular S corporation taxes, but we won't get into that. But for the most part, payroll taxes, self-employment taxes as we know them now, are not imposed on S corporation distributed earnings. The solution, though, is, or the requirement, though, is that you pay yourself a reasonable salary. So if you make $1 million, and if you pay yourself a $50,000 salary or a $100,000 salary, if the money that's coming in from the business is really generated from the work of your employees, you take $900,000 of S corporation income without having to pay payroll taxes on that. Another benefit is the retirement plans. We'll go into how material retirement plans can be later, but retirement plan contributions for an S corporation won't be subject to self-employment tax as well. With a partnership entity or sole proprietor, they are. So that's a dollar for dollar savings there as well. As I mentioned before, being a corporation, if you can't just take assets out of a corporation. If you distribute an asset from this corporation, you'll recognize gain or loss, unlike a partnership type entity. C corporations. So we generally do not recommend small businesses use C corporations unless there can be some way to manipulate the income so that you are only that the C corporation is recognizing only $50,000 of net income. Now, that's because above that rate, you're paying the full corporate tax rate. Below that rate, you're paying 15%. Now, this makes sense today when the dividend rate is 15%. The qualified dividend rate is 15%. Next year, when the qualified dividend rate is scheduled to go up to ordinary income, this particular strategy won't even work anymore. You'll face C Corp double taxation. The corporation itself will pay 35% tax on its own income, and then when it distributes a dividend to you, you're going to pick up another dividend tax of 35 to 39%, depending on where tax brackets end up, assuming you're at the maximum tax bracket. So that's a hefty tax, and it's not necessary. If you are a C corporation, you really want to consider making an S election. Once you are a corporation, though, you cannot go back to a partnership type entity or a sole proprietor type entity without recognizing gain or loss on your assets, right? Because you can't pull assets out of a corporation without gain or loss. So, but as a C, you do have the option to go S and avoid this double taxation moving forward. Especially again with dividend rates going up, C corporations are looking particularly bad. There is no capital gains rate for C corporations. So if you have capital assets and you wanted to have capital gains rate, not going to happen. You have to make an S election, and then you have the thing with C corporations moving to S. There's such a thing called the built-in gains tax that prevents you from taking advantage of appreciation that's built up in the C corporation at capital gains rates. So you do have to be cognizant of that. So the bottom line is, if you have an operating business, consider an S corporation. If you have a rental or an asset type business, consider an LP or LLC. If you're a sole proprietorship right now, if you have enough revenues to care about it, you probably should be looking into one of those other entity types. Now, moving on to accounting methods. For cash versus accrual, this analysis is whether or not you should be on a cash or accrual basis of tax accounting. The question is, do you have a lot of accounts receivables versus your accounts payables? If you do, then you should be on a cash basis method of accounting. What a cash basis method means, you don't pick up income until you receive the cash. Same thing with expenses. You don't receive the deduction until you pay the expenses. So the reverse is true. If you have a ton of accounts payables, but not so much accounts receivables, for instance, you're a retail business, for instance, you should be on an accrual method of accounting. That way you can get deductions for the expenses that you owe your vendors without having to pay for them yet, and you're not really receiving that big of a a disadvantage by going accrual and picking up your receivables, because your payables are far in excess of your receivables. Another thing that we see with our clients is there needs to be some inventory cleanup sometimes. So some people have inventory bloat. That may or may not be your business, but you see inventory that hasn't sold for 3 or 4 years and it's just sitting there. If you haven't done this exercise in a while, you could have hundreds of thousands or millions of dollars of deductions sitting there in inventory that you'll never sell anyway. You may as well just dump it and get the tax benefit for it. The same thing with bad debt management. If you've got this really stale receivable from a company that's gone, you should really be writing off that bad debt and taking a deduction for it. Same deal with something that's old that you think you'll never collect. Moving on to depreciation methods for real estate type businesses in particular. This is a good opportunity. We've seen this for manufacturing businesses as well. Anytime where there is real estate involved, though, this is or real property improvement involved. This is a good planning opportunity. So let's say that you've been depreciating a particular asset using commercial property life, 39 years, for the last 20 years or so. And let's say that a lot of it could be HVAC system or land improvements under 15 years, or should have been outright depreciated as equipment. Just whatever the case is, you weren't using the proper depreciation method the first time around. If you do a cross-segregation study and you get the correct lives of each one of these assets, you can find that you could have hundreds of thousands or millions of depreciation that you didn't take in prior years. You can make an election to recognize all of that foregone depreciation in the present year and get one big write-off for it in the present year. So that's a good opportunity as well. For 2011 and forward, there's an opportunity for service providers that provide services in California, that provide services for their clients outside of California. You guys might recall last year a ballot measure that changed the way apportionment is done for state taxes in California. You call it a loophole, call it a purposeful tax break. But if you provide services in California for out of state customers, you can basically say that if you elect single sales factor apportionment, you can exclude that income from your California corporate taxation year. So this will really only be saving you your franchise taxes if you're an S corporation or LLC. But if you're a C corporation, it'll save you your full income taxes. So this is something to be cognizant of. I think they're trying to change it. It's an issue that they're aware of. For sales of goods and services, there's a throwback rule, meaning if the other state can't tax you on that income, all of it gets pulled back into California. But there is no throwback rule for services right now. All right. A lot of times we see that our clients have a lot of loss limitation for whatever reason. Proper planning can get rid of basis limitations. So if you know that you're going to have a loss at the end of the year, and this loss is being funded by accounts payables or something, and you don't have the outside basis to take that loss, by the end of the year, if you put some cash in the business, defer your distributions, put some asset into the business to give yourself basis, you can take that loss. It's just knowing if you have basis problems, if you're going to have a loss this year, you can do something to actively mitigate this and take that loss. Passive loss limitation. So there's this category of income called passive income. Effectively, it's rental income or any business that you don't participate in. For rental income, or particularly real estate rental income, there's an election out there to be a real estate professional. So you have to spend more than half your time in the real estate business and more than 750 hours in doing real estate type work. If you do that and qualify, you make the election, your real estate losses, if you have them, will not be passive. You can use them to offset other income. So passive losses can only offset passive income. That's just that's the limitation rule. We see a lot of clients have separate entities that hold their warehouse, that hold their manufacturing facilities, real property that's associated with their active business. You can, there's the passive activity group. You can have multiple businesses that don't necessarily meet the material participation requirements to be an active business, but if they're all related, you can group them together. Starting 2011, you have to start declaring those groupings, but before that, you didn't have to, and you kind of assume that they were grouped together before if you treated them all as active in the first place. But that's one thing to keep in mind, that you can group activities together, and you don't have to take a passive loss on a real estate entity that you're that's effectively your manufacturing plant. We've seen that happen to a lot of our referral clients that come to us. For investment interest, there are planning avenues to make it so that investment interest is not categorized as investment interest. Investment interest expenses can only be deductible against investment income. We've seen this happen. If you borrowed money to buy a partnership or S corporation, a pass-through type entity, that's not investment interest. That is business interest rather the interest is flowed through to the partnership. So it looks at what the underlying asset of the partnership or S corporation is, and the character of those assets, assuming it's an active business, that will be business interest. That's not investment interest. I don't know how many times I've seen this. Other practitioners treat that as investment interest and limit it. It's not. Another thing you can do is if you're going to have personal interest problems, so if you're borrowing money for personal expenses, that interest won't be deductible. But if your business has borrowing capacity and it has earnings, what you can do is you can distribute those earnings to yourself and borrow at the business level, and that'll be business interest, and you have the cash flow from your business earnings to pay for whatever personal expenses you have, including possibly a mortgage deduction, a mortgage that's beyond the 1.1 million limit, if that's the case. So the way interest works is what you borrowed the money for is the classification of the interest. Well, then some planning can make it so that you borrowed the money for business purposes, because there's a lot of planning opportunities there. I'm going on to tax incentives now. So the Section 199 deduction, this basically, if you make something, if you are a producer of tangible goods in the U.S., you should be taking this deduction. It's 9%, limited to 9% of your net income, limited to half of your W-2 wages. This is kind of a replacement for an export incentive that was shot down by the WTO a while back. So, but if you make stuff in the U.S., you should, it's that simple. You should be taking this deduction. I've seen some practitioners just miss it entirely. All right. So, moving on to the R&D tax credit. So, this tax credit, the key point I want to bring up here is the definition of R&D is pretty much anything that's of technical nature that requires the scientific method to resolve. Scientific method effectively meaning trial and error. So you might not think you're doing R&D, but the definition is defined so broad as to include anything that you have to basically test as being R&D. If you have a production line and you're retooling your production line, that is R&D. If you are an engineering firm and you have the responsibility, if you're not on time and material basis, and if you're hired to do a particular design, you have to deliver the design. That engineering work is of technical nature. Your particular engineering duties, if you will, or what you're doing is of a scientific nature, and that qualifies as R&D. The bottom line is a lot of things that you might not think qualifies as R&D qualifies as R&D. Almost every business has a little bit of R&D that they're doing. And it's not limited to what you think is purely making new products or designing new things. R&D is a very broad thing. So the question is, do you do enough of it to warrant looking at this particular credit? It's a 20% credit of the qualified research expenses, which effectively is your W-2 wages of the employee conducting the research. It's up to there's supplies that you can take as well, but normally that's minimal. We're mostly talking about the W-2 wages of the people doing the R&D. It's a worthwhile credit. We've seen millions of dollars come back to our clients from being informed of this credit. So it's there, it's real, and it's broad. You should consider it. All right. The California Enterprise Zone credit. This thing's missed a lot as well because the enterprise zones are constantly changing as well. So if you go to that link that's on the screen, you can download a booklet with a listing of the 42 designated California enterprise zones. If you're in a California enterprise zone, you get a sales tax credit for computer equipment, telephone equipment, information technology equipment that you put into place where you at your office in the enterprise zone. If you hire an employee of a particular class, you can get a credit of up to $37,000 per employee for hiring such an employee. Now, there's a lot of, I'll go over the next slide here. There's a lot of categories of what employees qualify for the easy tax credits. The big ones, the easy ones, are where they live. There's a targeted employment area, and you can get the listing, the address listing, by going to the particular municipality's website from that booklet that I referenced above, on whether or not your employee qualifies. Now, this is a hiring credit, meaning if you haven't hired anybody in the last 5 years, this credit won't apply to you. But if you have hired people in the last 5 years, you can amend returns and get these credits that you haven't taken in the past. So the big ones again is if those employees that you hired lived in a targeted area, or if they've been long-term unemployed. There's a lot of other categories, like if you're that particular employee is on federal assistance or an ex-felon or whatnot. But you can read through the list, but the big ones usually are where they live and whether they're long-term unemployed. All right, an IC disk. If you export, if you make something in the U.S. or if you provide more than half the value by your processing in the U.S. for a particular good, and you export it, the IC disk will provide to you, will allow basically half of the net income from those exports to be taxed at capital gains rates, or rather the qualified dividend rate. So the qualified dividend rate is going away next year, but hopefully it will be renewed. If it is renewed, this particular incentive will stick around. But if it isn't, then this incentive, it won't mean anything. But this particular incentive allows you to fundamentally take half of your income, or up to 4% of your gross receipts, whichever is greater, export gross receipts, whichever is greater, back as a capital gains rate. I won't get into the technicalities of how this works, but it's running out a little bit out of time. But that's what it is. Small business healthcare tax credit. So we've gotten a lot of questions about this credit from our clients, and the fundamental thing that we're coming across is that most of our clients, in fact nobody that we've seen really qualifies for the full credit, and if they do qualify, it's so limited, it's a couple $100, it's not even worth the effort. The reason for this is that we're in San Francisco and we're in California, and in order to fully qualify for the credit, you need to have an average employee compensation of less than $25,000 for full-time employees, less than $25,000, or fewer than 10 employees. That's, I think, probably impossible in the SF Bay Area. I don't know how possible it is in the rest of California, but the phase-out is pretty drastic, and by 50,000 average comp and by over 25 employees, there's no credit available. So just wanted to address that this credit is available, but at least for us, we haven't seen it available to any of our clients in any material form. Okay, and the last thing we want to talk about are defined benefit plans. So you guys might all be familiar with 401ks, IRAs. Those are defined contribution plans. A defined benefit plan is effectively a pension plan. Now, we bring this up because for small businesses in particular, there is a great planning opportunity because you can structure a defined benefit plan to provide equivalent benefits to your employees as a defined contribution plan, but end up giving to yourself contributions in the $100,000 to $200,000 range each. That's a magnitude of 2 to 4 times what you could give yourself under a defined contribution plan. I mean, in the most extreme cases, one employer I saw was able to put in $600,000 into his pension plan in 1 year, all in one blow. And that's also because the reason you can do this is that defined benefit plans are age weighted, so you can if the older you are, the more you can contribute at one time. So basically, it allows you to catch up for lost time, if you will, which most small business owners they probably didn't put all that much in their retirement plan because they're putting money into their business. So if you have a successful business now and you're just taking that money and you're sticking it in the marketable securities, you may as well do it through on a pre-tax basis through a DB plan, and the assets in the DB plan will grow on a pre-tax basis as well. So it's a pretty powerful tax planning tool. So that's all I got for today.
Anthony, thank you so much for that detailed and insightful presentation. We want to let you all know that we have recorded this, and we'll put it up on our website. It'll be available in about a week if you want to review it, or if you couldn't listen to the whole thing, or you have other people that might want to listen to it. Our very popular webinar in September that we did about the November election, that is now available on our website. So if that's of interest to you, please go look at that and tell your friends about it. Next month, on November 20th, we'll have our investment committee update that we do in the middle of every quarter. That is for clients only, but we encourage our clients to tune into that. That'll be November 20th at 2 o'clock from 2 to 2:30. We didn't have time to review any questions on the broadcast today, but if you do have questions, we'll make sure that Anthony answers them. We'll forward those to him. And here's our contact information. We always encourage you to reach out to us and to follow our various blogs and Twitter and LinkedIn. I want to thank you for joining us today, and thank Anthony Liang for this great presentation. We really appreciate it, and we'll look forward to seeing you again soon at another broadcast or event. Thank you very much.